Good evening, ladies and gentlemen. This is Rashmi Mohanty, Head Group Investor Relations for Vedanta. Thanks for joining us today to discuss our fourth quarter and full year results for FY18. We will be referring to the presentation that is available on our website. From our management team, we have with us our CEO, Mr. Qtr4, our CFO, Arun Kumar, and we also have several of our business leaders with us. Sudhir Mathur from Oil and Gas, Amitabh Gupta from Hindustan Zinc, Deshni Naidu from Zinc International, and Samir Khaire and Ajay Dikshit from Aluminium and Power Division. Let me hand it over to Mr. Kora to provide an update on the company's operational performance.
Thank you, Rashmi. Good evening, ladies and gentlemen. I am pleased to welcome you to Vedanta Limited's fourth quarter and FY18 earnings conference call. Starting with the commodities market, commodity prices saw sharp appreciation over the year, fueled by supply-related reforms and disruptions, stable demand, a weakening dollar, and bullish global growth indicators. Our commodity basket benefited from the favorable price movements, with ramp-ups across various businesses leading to record production levels. Let me take you through our performance for the year. I'll start with safety and sustainability. Vedanta remains focused on zero harm, zero waste, and zero discharge. It is therefore with great sadness we report 7 fatalities during the year. We remain committed to bring Vedanta to the best HSE performance in the resources sector. These fatalities have resulted in some serious introspection within the group, including increased oversight from the Group Executive Committee. Some of the areas we are focusing on are visible leadership, rigorous implementation of safety standards, and management of high-risk areas. We have augmented our HSE organization by induction of 10 HSE experts with global experience. A focus on training, where last year our employees and contractors spent 1 million hours in safety training. On the positive side, our oil and gas business has been awarded British Safety Council 5-star rating for all of its Rajasthan and midstream assets. In the area of environment, we were able to exceed our water saving target by 109% last year and exceeded our energy savings target by 275%. Last year, we started that with we expected to reduce our GHG intensity by 16% by 2020 from 2012 baseline. I am pleased to report that nearly 2 years before the target date, we have reduced the GHG intensity by 14% and are well on our way to meeting the expectations. Third-party audits for our tailing and ash management practices were completed. Improvement opportunities were identified and corrective actions are being implemented by businesses. Individually, our businesses continue to improve on their sustainability practices. On the Dow Jones Sustainability Index for the metal and mining sector, Hindustan Zinc improved its overall ranking to 11th position and was inducted into the prestigious Dow Jones Yearbook. In the environmental category, Hindustan Zinc moved from 11th to 3rd place and Vedanta Limited improved its ranking from 17th to 15th place. Finally, work on our flagship CSR program, Nandigarh, continues. Till date, we have built 154 centers in Rajasthan, UP and MP, and we are perfecting the pilot. We remain committed to building 4,000 Nandigarhs. FY18 highlights. Our operational performance was strong this year on various fronts. We had record annual production at Zinc India and successfully completed the full transition to underground operations with no significant increase in costs. At Oil and Gas, we achieved an exit production run rate of 200,000 barrels at March end. We also delivered record annual production at aluminium and exited the year at a production run rate of 2 million tons per annum. We also delivered strong financials. I am happy to report that full year EBITDA was rupees 25,500 crore, 19% higher year on year, and PAT was rupees 8,200 crore, 10% up year on year. We have maintained a robust EBITDA margin of 36%, supplemented by favorable markets despite inflationary cost headwinds. We delivered free cash flow of rupees 7,900 crore and reduced our gross debt by rupees 8,500 crore. We also paid the highest ever interim dividend by rupees 21.2 per share, summing up rupees 7,881 crores during the year. The strong performance of 2018 paved the way for an exciting 2019 as we remain committed to developing all the growth opportunities available to us. I am excited about these opportunities and happy to take you through these growth projects. In Zinc India, in 2019, we'll hit a run rate of 1.2 million ton mine metal capacity and are on track to achieve this steady state capacity by financial year 20. Moving to Zinc International, the Hamsburg project is on track to commence production in mid-calendar year 2018. In the oil and gas segment, contracts of 1.3 billion have been awarded on the new projects and execution on the ground has commenced with first oil from these projects coming in this quarter. The announcement on intention to acquire Electro Steel under the IBC process is a step towards value addition for our iron ore businesses. We see favorable market dynamics for steel in India and together with integration efficiencies with our iron ore business, see this acquisition as value accretive for Vedanta. We'll talk more about the progress on each of these projects later in the presentation. During the year, we focused on all-around operational excellence by debottlenecking our assets, adopting technology and digitalization, strengthening people practices, vendor and customer base enhancement, and spend-based optimization. For example, in the oil and gas business, we have provided our partners with end-to-end responsibility for project management, providing incentives and measurable outcomes on production, delivery, and safety. At the Sindesar Khurd mine, we have piloted digital technology for transformation to an automated mine. At Hamsburg, the project will boost leading-edge systems that report the state of mine, the quality of ore, the conditions of the concentrator, and quality of the concentrate, all in real time to enable minute-by-minute decisions. Business-wise highlights. Moving on to our business-wise highlights on operations, we have delivered strong volumes in the quarter and continue with production ramp-up across our portfolio. At Zinc India, we had record annual refined metal production of 960,000 tons, along with record silver production of 558 tons. Our cost of production ex-royalty was $976 per ton, 18% higher year-on-year in dollar terms due to increase in input raw material prices, primarily coal and met coke, lower grades, and India rupee appreciation. We remain on track to achieve our 1.2 million ton target in FY20. At Zinc International, we delivered stable production. We had some cost headwinds this year due to higher shipping costs of pit 112 and Scorpion from early ore production and unfavorable local currency appreciation. At Hamsburg, we are on track for cold commissioning of the concentrator plant in Q1 this year and expect to commence concentrate production in mid-FY18. At oil and gas, as mentioned earlier, we exited the year at a production rate of 200,000 barrels per day. On the growth projects, the drilling of 15 Mangla infill well at Rajasthan has been completed. The 3-well Cambe infill program has also been completed in this month. We have successfully ramped up RDG Phase 1 to 45 MMSCFD. Aluminium, we delivered record volumes and exited the year with a run rate of 2 million tons per annum. However, inflationary cost pressures in alumina and carbon, as well as availability issues for coal, impacted the cost of production. We have taken measures to address this cost, which we will cover in detail later. Moving to power, TSPL delivered record 90% availability in the second half of the year and delivered strong year-on-year growth. At iron ore, we produced 4.9 million tons this year. As you must be aware, the Supreme Court in February has put a stop on all mining operations in the state of Goa with effect from March 16, 2018, and our Goa mining operations are shut since then. In Karnataka, we produced 2.2 million tons during the year and await the increase in capacity allocation as the mining cap for the state has been increased. Copper India business recorded a production of 403,000 tons this year. Average TCRCs were lower 5% year-on-year at the back of strong copper demand and prices. Our operations at Qtr4 are currently shut down as our application for renewal of the consent to operate has not been approved. We are working with the regulatory body to provide the required clarifications in order to obtain a positive outcome for our application. At this point, I would like to remind you of the company's strategic priorities which drive our business model and approach. Operational excellence is something I have spoken about earlier. We continually strive to improve our operations, sweat our assets, optimize costs, and improve realizations. We remain committed in our efforts to achieve our objectives of zero harm, minimizing environment impact, and creating sustainable value for all our stakeholders. We are focused on generating strong cash flows and maintaining a strong balance sheet through prudent capital allocation. On growth, I am excited about the growth opportunities, both organic and inorganic, which align well with the demands of a fast-growing Indian market. We have various brownfield opportunities in our businesses, and we took key steps to monetize them in FY18. We also continue to identify superior inorganic opportunities in the natural resources segment that synergize and add value to our portfolio. Our world-class mines have long lives, and we have been continuously adding to reserves through exploration. For instance, at Zinc India, gross addition of 19.5 million tons were made to reserves and resources, thus ending the year with estimated RR of 400 million tons. Overall, mine life continues to be more than 25 years. I will now hand over to Arun, who will take you through financials.
Thanks, Mr. Kora. I'm happy to report yet another operation-led strong quarterly financials. Before I dive deeper into the numbers, a few highlights. Based on the Q4 run rate, our yearly net revenue, you can easily see, crosses 1 lakh crore. This is the highest ever quarterly EBITDA in 5 years. The full year EBITDA at 25,000 crores plus is yet another landmark. For the year, the EBITDA growth was about 19% compared to previous year. The margin continued to stay strong at 36%. This is reflected in the double-digit growth in the attributable net profit as well. The bottom line at rupees 8,025 crores. On the balance sheet, you would note that we continue to be strong on the net debt to EBITDA ratio below 1 and closing cash of around 36,000 crore. These are best-in-class numbers that I've been alluding to for over the past year. The gross debt, again, as you notice, has come down by approximately 8,500 crores, and if you include the temporary borrowing at Zinc India, then it's down almost 16,500 crores. ROC, again, measured conservatively on a post-tax basis, has crossed 15% for us, ending at about 17.5% for the year. Q4 annualized will be about 20% in fact. Cash flow post-capex continued to be strong. We believe these are important milestones achieved through a strong operational performance with volume growth across all businesses, supported, of course, by a good price environment as well. The volumes and costs were largely in line with the guidance during various points of the year. While I have a detailed income statement in the appendix, but important to cover a few details out here. In March, we announced an impairment charge in our iron ore business at Goa, essentially the mining reserve of goodwill in the pre-Ind AS days, which was written down consequent to the Supreme Court judgment on leases. Today, I'd like to focus on the 4,200 crores of net of tax impairment reversal in the oil and gas business. Over the last 6 quarters, more specifically in the last 2, we've been talking about the 7 or 8 key growth projects with over 2 billion of gross capex in the next couple of years with IRRs exceeding 20% at a conservative 40 Brent. This has led to a re-rating of the reserves and resources and hence overall valuation of the oil and gas business and hence Vedanta, with the accounting impact manifesting as an impairment write-back. Sudhir, our CEO of the oil business, will talk a little bit more about the excitement in a section coming up after the finance section. Finance cost or interest cost, as you've been observing, over the last 2-3 quarters was in a downward trend. Our interest cost has been less than 8%, I think about 7.87% for the year on an average. Of course, with the yield curve hardening in the recent times, we expect the cost to move up maybe 25 to 40 basis points during FY19. On the interest income line, pre-tax, we earned about 7.4% and continue to invest in high-quality AA plus safe instruments certified by CRISIL. The reported numbers, of course, from quarter to quarter get impacted by mark-to-mark, given the various up and down movements on the G-Sec or the yield curve. For FY19, one should expect around 7% underlying pre-tax return of our investment portfolio, of course, subject to, again, mark-to-mark. Depreciation for FY19 should be significantly higher, given higher volumes at the mining and oil businesses, which is basically zinc and oil and gas. Full year impact of ramped up assets like in aluminium. Depreciation impact of the new capitalization proposed like the Ansberg mine and the higher asset base with now the impairment reversal in the oil and gas business. For FY18, the final tax rate was just about 30%, excluding DDT and tax and special exceptional items. It's marginally higher than what I had guided during the year. I had guided a range of 25 to 30% and specifically mentioned we'll be at the higher end of the range earlier in the year. So that, of course, would have meant a higher tax rate for the current quarter, as can be seen in the numbers, largely a function of profit mix, legal entity mix, and deferred tax accounting. For FY19, the overall effective tax rate is likely to be in a similar range of, let's say, 26 to 29 or 30%. In March 18, we also declared and paid the highest ever interim dividend of rupees 7,800 81 crores or 21 rupees 20 paisa per share. This is also the total dividend for the year in line with our dividend policy. The contribution to exchequer for the year is around 33,000 crores. Third year in a row that it's above 30,000 crores. So with that, I hope you have a good sense on the quarter's numbers as well as headline guidance for FY19, especially below the EBITDA lines. Moving on to the next page, on the EBITDA bridge. As you can see on this page, our full year EBITDA was up about 4,000 crores. As I mentioned earlier, a 19% growth over last year. 50% of this incremental EBITDA was driven by strong volume performance across all businesses. Record annual production in zinc, India, with 18% increase in integrated metal, 23% up on silver. The record aluminium production exit run rate was about 2 million tons, exactly what we had guided, benefiting from the continued ramp-up. And oil also exited at 200 kBOPD, which was touched after a couple of years. So it's on its way up. This lays the foundation, I would say, for a further increase in volume for FY19, as per the guidance given in this presentation, across oil and gas, zinc international, and the full year impact of a stabilized volume in aluminium. On the external side, while prices held but significant input inflation offset nearly half the price gain. So more or less the 4,000 crore you could say was half of operational and the other half being price on the overall year basis. Moving on to the next page on net debt. During the year, we remained focused on our stated financial priorities, which is strengthening the balance sheet by focusing on the free cash flow generation. We generated cash of nearly 20,000 crore from the operations. This was deployed in CapEx and other activities, and post-CapEx and some proactive adjustment to managing working capital funding given the ramp-ups and some of the disruption in the banking sector around LOUs, etc. in March. The movement of almost the 4,000 crores entirely as a result of shifting into term loan funding instead of working capital products. Net of that, we generated around 7,900 crores of healthy cash. Due to record dividends, which I alluded to earlier, 21 rupees 20 paisa, and the acquisition glass, we defrayed the earnings, thus taking the net debt higher. But again, needless to say, I keep reminding all of us about the net debt EBITDA ratio, which continued to remain below 1, precisely at 0.9x. Again, best in class as mentioned earlier. Moving on to the next page. The company continued to manage its debt book with the dual objectives of delevering and reducing the cost of borrowing. We've spoken about the gross debt reduction earlier. Again, if I have to focus on the credit ratings, the agencies have moved us, both agencies, the local agency moved us into AA positive. We will continue to generate strong cash flows on the strength of higher volumes in FY19 and allocate it wisely to high return growth projects, further delever the gross debt, and provide adequate return as well as appreciation to the shareholders. On that note, let me move to the next page on our CapEx guidance, talk a little bit about the allocation of the earnings. CapEx guidance for FY19 comes at around $1.5 billion as against the FY18 actuals of about $800 million. It was marginally below our guidance at mid-year. The increased level of CapEx for next year is driven largely by the increase in oil and gas, given all the project announcements which we have made. It will also lead to higher production levels with the immediate FY19 guidance at 225 to 250 kBOPD, which will be an increase of 20 to 35% as compared to FY18 at either end of the range. We will talk more about it. Our Zinc India management team covered their guidance in the Hindustan Zinc results day before, with plans announced to take the production beyond 1.2 to 1.35 per annum in the near future. Zinc also includes the spends on Amsberg as it achieves commercial production mid-calendar 2018. The capex will all be self-funded from the EBITDA of the year, all of them returning an IRR of well about 20% at conservative price assumptions, and that you can appreciate is well above our WACC, or the weighted average cost of capital. In summary, focus on fundamentals of operating excellence, thus generating free cash flows to fund growth capex, deleveraging, and shareholder returns will be our fundamental endeavor. The balance sheet will continue to remain strong. We'll stay proactive on refinancing, credit improvements, and keep improving on the ROCE, which is already at global standards. With that, thank you all, and back to Mr. Qtr4 for the business section.
Thank you, Arun. India slide. India is the fastest growing G20 economy in the world with strong fundamentals and demographics. According to the IMF WO April 2018, the Indian economy is projected to grow around 7 to 8% per annum over the next few years. Currently, per capita consumption of metal in India is 70 to 80% below global average. As the country expands, domestic consumption of key commodities will increase substantially, both through the demand growth and higher intensity of usage. Furthermore, the Government of India has introduced a number of important reforms like amending mining laws to make mine auctioning transparent and encourage private ownership, which has improved the business improvement, attracted global investment, and is driving faster growth. Vedanta, as the only diversified natural resources company in India, is uniquely positioned to cater to that demand. Next slide. High return growth projects with further optionality. Vedanta stands out from its peers as it has many brownfield opportunities for growth. This slide is a snapshot of our growth projects across various businesses, detailing the near-term growth which is underway and on track by completion by FY20, as well as the medium-term growth projects. As an organization, we are well equipped to deliver on these growth projects with the requisite management bandwidth, global talent base, and systems in place. I will now hand over you to our oil and gas CEO, Sudhir Mathur, who will give you an idea about Vedanta's potential in oil and gas segment and cover details about our growth projects. Sudhir.
Thank you, Mr. Qtr4. And good evening to you all. In the oil and gas business, we are moving ahead in the right earnest towards our vision of contributing 50% to India's total crude production. The key to realizing our vision is to augment our reserves, which is essentially the quantity of oil and gas that can be produced during the remainder of our license period. Our initiatives here are two-pronged. We strive to front-load production and extend the license period, both of these within the construct of a superior commercial value. Let me take you back in history, which will put our performance on this count in perspective. In the year 2009, the year we started producing in Rajasthan, we had estimated gross reserves of 539 million barrels of oil equivalent. Since then, we have produced 604 million barrels of oil equivalent. Now let me add another data point. At the end of 2018, we are sitting on a potential of 683 million barrels. So by leveraging leading-edge technologies, focusing on growth projects, pursuing the PSC extension, we've been able to generate a production and reserves of 1.3 billion barrels of oil equivalent since 2009. With the PSC getting extended, an incremental 176 million barrels get added to our reserves, for which capital investments have been made. As you would see from the graph, we have another 580 million barrels of contingent resources that we are yet to commercialize. Now let's talk of our growth projects.
Mr. Sudhir, I'm sorry to interrupt. May I request you to come closer to the mic? You are not clearly audible.
Sure, thank you for that.
Thank you.
Our growth projects include a rich mix of enhanced oil recovery, tight oil, and tight gas projects involving gross capex of $2 billion over the next 2 to 3 years. These growth projects have an IRR in excess of 20% at an oil price of $40 per barrel. These investments are expected to deliver an incremental peak production of 200,000 barrels per day. Let me dwell on these projects one at a time. Next slide, please. Our model of project execution has yielded substantial benefits with our capex in the range of $5 to $7 per barrel. Contracts of over $1.3 billion for these projects are already in place. Project execution is underway with 4 rigs currently at site in Rajasthan, which we are looking to scale up to 9 rigs by August 2018. The polymer enhanced oil recovery at Mangla, which is now a global benchmark, is being replicated in the Bhagyam and Aishwarya fields with a target to deliver incremental 5% recovery. The first well has been spud both at Bhagyam and Aishwarya in the last month. Now we are going for alkaline surfactant polymer, or ASP, to further boost recovery by about 10% from our prolific MBA fields, taking the overall recovery to around 45%. The success of the ASP pilot in Mangla has paved way for the phased implementation of ASP in the MBA field. The expected ultimate recovery is about 200 million barrels at a capex of over $950 million. We have awarded the drilling contract and are on track to commence drilling from August 2018 and tendering for the surface facilities underway. Moving on to tight gas. The Rajeshwari Deep Gas Project presents an opportunity to scale up our gas business significantly. The first well has spud in RDD in April 2018. The surface facility contract primarily to build the terminal has been awarded and execution is scheduled to commence by the end of this quarter. We are also looking at an early production through a rental arrangement of surface facilities as soon as the GIDL pipeline is ready in H1 FY18. We are on track to monetize the Aishwarya Barmer Hill, our tight oil project. The 2-rig drilling program comprising 39 wells is on track to spud in May 2018. We have commenced a 45-well infill program in the prolific Mangla field to generate an additional 18 million barrels of oil in the near term. The rig is on site with the first well spud target of May 2018. We are upgrading liquid handling capacity at the Mangla processing terminal to accommodate post-expansion volumes. Contracts will be awarded during the current quarter. In aggregate, we are seeking to add around 375 million barrels of gross reserves on account of our growth projects. We have set ourselves a target of 220-250 KPOPD average volume in FY19 as against the 186,000 barrels we achieved in the past year. Going by April production, which exceeds the FY18 average monthly production by around 9%, and a clear roadmap ahead. We should be well within reach. Moving on to the next slide. We are investing in exploration. We have identified a number of high-impact undrilled leads and prospects in Rajasthan, and we will start drilling of 7 to 18 wells in August, 7 to 18 wells, contracts for which have already been awarded. Beyond Rajasthan, we have a 100% participating interest in KG offshore block in the prolific Krishna-Godavari basin. The first well of the 2-well program campaign has spud in April 2018. These pertain to our current acreage. We are also looking actively to add to our current acreage across the key prolific basins in India under the government's open acreage licensing policy. We have bid for the 55 blocks on offer and expect to increase our exploration portfolio significantly to continue building the reserve and the resource base aggressively. Now that you have a fair idea of our efforts to enhance and monetize our reserves and resources, let me leave you with one parting thought. At the time Came India, when it was listed separately, started producing in Rajasthan in 2009, we had potential reserves of 539 million barrels. With an oil price of around $50 per barrel, our market cap stood at $7 billion. Today we are sitting on a potential reserves of 683 million, with a proven track record of producing way in excess of our reserve estimates. The current price per barrel today is about $70. Some food for your thought when you start looking at valuation. Thank you all. Over to Mr. Khan.
Okay. We go on slide on aluminium. Aluminium has been a strong ramp-up story this year. We enter FY19 with confidence in converting our exit run rate of 2 million tons into a stabilized production level. The final set of pots in the third line of 1.25 million ton Jharsuguda smelter will fully ramp up within the first half of the year. This year was, however, not without its challenges. Inflationary cost pressures across alumina, coal and carbon escalated the costs in the business. Alumina continues to trade at all-time high, driven by the supply tightening from Alunorte's partial refinery shutdown and uncertainties due to U.S. sanctions on Rusal. Therefore, as a strategy, we have looked at ways to optimize our controllable costs while also increasing the price realization in order to improve profitability in a sustainable way. In the medium term, we are aiming at a COP target around $1,500 per ton level by focusing on a number of aspects. Let me detail some of the key points. On alumina, we are targeting production of 1.7 million tons of captive alumina in financial year 19 with the potential to move up to 2 million tons. Part of the bauxite sourcing will be from the state of Odisha, which will add higher quality, low-cost bauxite to our refinery feed mix. Together, these two factors will lead to reduction in alumina costs. On power, we are working towards improving plant operating parameters, which will deliver higher PLF and overall reduction in non-coal costs. We are also working towards increasing our linkage coal mix from 45% currently to a target of 70% through full materialization from linkages and increased coal linkages. In summary, we expect to reduce cost of production by about $120 to $170 range in FY19 by optimizing controllable costs and through elimination of one-offs. However, the supply dynamics for global alumina and prices for other input commodities remain uncertain. So while it's difficult to guide a COP for FY19 today, assuming costs of imported alumina, coal e-auctions and carbon at average FY18 levels would imply a cost of production of around $725 to $775 range per ton in FY19. Concerted efforts on these cost initiatives will continue to support us in achieving our $1,500 tons target. On the product and marketing side, we are targeting a 35% increase in value-added production in FY19 to about 1.1 million tons. These and other efforts, along with improved headline premium, is expected to contribute about $50 per ton to the EBITDA margin in FY19. Our target is to progressively increase value-added production and long-term OEM sales further. Moving to Zinc India. At Zinc India, our strategic vision is to grow our zinc-lead output to 1.5 million tons per annum and our silver portfolio to 1,500 tons. I am pleased to announce that the board of SZL this week approved the phase 1 of this expansion, which will increase the mine metal and smelting capacity from 1.2 million tons per annum to 1.35 million tons over a period of 3 years at a capex of approximately rupees 4,500 crore. Phase 1 will be done concurrently with ongoing mining expansion, which is now in its final stages. We are capable of delivering 1.35 million tons of mined metal in 3 years from now, while silver production capacity will double from the current level. A salient feature of this next phase of expansion will be the use of technology to increase productivity, efficiency, and safety. We are deploying autonomous machines enabling 24/7 mining to increase production hours and fleet availability. Our mines will be digitalized for centralized monitoring and control to maximize equipment effectiveness and improve safety. These measures, along with some other initiatives like predictive maintenance, will create capabilities for cost optimization in future. In short, our mines will be smart, connected, intelligent mines which will be safer and more productive. We will be expanding our smelting capacity simultaneously to match mined metal capacity of 1.3 million tons per annum via debottlenecking of our existing smelters and addition of a new smelter. Also, a new silver refinery of 200 tons per annum will be set up in Chanderia to process higher silver feed. Hemsberg expansion. Hemsberg is the anchor project for our growth plans at Zinc International. It has a huge potential with its large R&R of 215 million tons with 15 million tons of zinc. We have been following a modular approach by developing this huge resource in a phased manner. Phase 1 of the project is currently under execution and on track as per schedule for production from mid-18. Phase 1 will have a capacity of 4 million tons per annum run-of-mine production with a 6.5% zinc grade and 250,000 tons metal in cons. In terms of resource, Phase 1 is only targeting 1/4 of the total resource. This gives us flexibility to scale up. Hemsberg Phase 2 can start immediately after completion of Phase 1 project, and this should be quite straightforward with a lot of synergy with Phase 1. The mine plans have been developed and expanded mega pit design completed to enable a faster and efficient Phase 2 execution. In terms of output, we can expect to add another 200 to 250,000 tons metal in concentrate in 2 to 3 years. It's our vision to sell finished zinc metal from Hemsberg, and towards this, we are evaluating various possibilities for converting concentrate to metal. Let me cover iron ore and copper briefly. Iron ore, in early April, we received a favorable order from NCLT for our bid to acquire Electrosteel. We are working towards completing this acquisition. This is an exciting step towards adding value to our iron ore business. We see steel as a natural value add for Vedanta's iron ore business, and the Indian steel sector is among the fastest growing globally. The IBC process gave us an attractive entry opportunity to enter this sector. Electrosteel runs a blast furnace and produces long steel in the state of Jharkhand. We see a number of opportunities to turn around this asset, including the immediate ramp up to 1.5 million tons and subsequently to 2.5 million tons, and synergies to be developed with Jharkhand Iron Project. Copper. At Copper India, our expansion plan to double smelter capacity from 400,000 tons to 800,000 tons per annum is underway. The EPC contracts for all main packages, power distribution and automation packages have been awarded. Slide on key investment highlights. Let me wrap up summarizing our key investment highlights. Vedanta's large-scale diversified portfolio with attractive cost positions in the core businesses position us well to deliver strong margins and cash flows through the commodity cycle. We have positioned ourselves in base metals and oil, make our commodity mix particularly attractive. India is Vedanta's core market and one which has huge growth potential. We are strongly and uniquely positioned to benefit from this growth. With the number of capital investment programs completed, we are ramping up production across businesses. Along with the new growth plans in oil and gas, we expect further delivery on ramp-ups going forward. We are consistently striving to improve our operations, integrate our businesses through the value chain, and optimize our performance through operational efficiencies and innovative technological solutions. Our operational performance, coupled with a strong focus on optimization of capital allocation, has helped strengthen Vedanta's financial profile. We have a proven management team with a diverse and extensive range of sector and global experience to ensure that operations are run efficiently and responsibly. These factors enable us to deliver sustainable long-term returns to our shareholders and to create value for our broader stakeholder base. With that, I would like to thank every one of you and open the call for questions and answers.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abhishek Poddar from Kotak Securities. Please go ahead.
Hi, thanks for taking my question, sir, and congratulations on a good quarter. My first question is regarding the one item in the aluminum operation. So this is regarding capitalization of pot relining expenses. I want to understand what is this item, which period it pertains to, and how much was the amount involved for this?
Yeah, I think this is Arun here. Let me take that. This is just a accounting correction of what normally happens in the industry, where the pot relining gets depreciated over the next 5 years. Instead of what we used to do earlier is charge it off in the same year. So we took a period-to-date correction as well. It has literally zero impact on the net profit. It just moves between depreciation and EBITDA lines. It's about 300 odd crores movement between the lines. EBITDA is up, depreciation is up, so it's pretty much an accounting thing.
So this pertains to previous quarter?
Yeah, it pertains to the year. So it's as I said, the impact on the bottom line is nil. So let's move on.
Sure. And so the second question is regarding the Qtr4 copper smelter. What is the state right now, and when do you expect a resolution?
You see, as we are aware that the consent to operate of Qtr4 was not approved, and we have engaged with the authorities with the responses to some of the questions which they raised, and we believe the resolution for this should happen soon.
Okay. And so the last question on the bauxite mining in Odisha. What kind of bauxite do you expect to get from Kodingamali mine? Whether we have already formed any of the sourcing? And are there any other mines also that you are OMC is looking to, start mining from?
The OMC at present is operating this mine only, and we started sourcing the bauxite only from the recent past. This mine has come into production, and this mine will ramp up progressively, and our offtake will correspondingly increase.
Okay, thanks a lot, sir.
Thank you. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. The next question is from the line of Vineet Mali from Birla Sun Life Insurance. Please go ahead.
Hi, good evening. It's actually Vedanta Ltd Mutual Fund, nevertheless. So my question is on aluminum. Just wanted to understand this a little bit in detail because it seems that with the 1,510 of EBITDA.
Yeah, we need...
Hello?
Can't hear you. Can you repeat your question?
Yeah, I'm saying that, we've done 1,310 crores of EBITDA in aluminum versus 600 crores.
Can't hear the question.
Hello, is it better now? Hello? Hello?
Yes, Vineet.
Yeah, am I audible now?
No, I think just why don't you dial back? We can't hear the question.
Okay, in the meanwhile, we will we'll take the next question from the line of Sumangal Nevatia from Macquarie. Go ahead.
Yeah, thanks for the chance. First question is with respect to the Zinc International. Now, there's been a sharp increase in cost at around almost $2,000 versus guidance of $1,700 last quarter. And even that was said to be temporary, whereas for FY19, we are talking about a similar range now continuing. Can you explain a little bit on this?
I see this increase in cost is because of this development of the Scorpion pit, and we are pre-stripping the pit in this year and next year. We've almost done half of it, 45% this year. So that actually element of the pre-stripping cost adds to this unit operating cost. Arun, you want to supplement anything?
I think that's absolutely well said. And the bigger point in Zinc International is the Amsberg mine coming on stream middle of this year at extremely competitive cost. The mining cost we have indicated will be about $500, $550, and the overall, including TCRC, etc., is $1,000. Very much in line with the guidance we've been talking about for the last 1 year or so, and that will be the majority of the production coming from Zinc International going forward.
Understand. Second is with respect to a plan to now evaluate a smelter refinery at Amsberg. Now, are there any challenges in selling concentrate? And also, given TCRCs are at record low, what IRR are we getting with this expansion?
See, I think this subject, you need to see it from a philosophy point of view. We actually like to sell finished metal, as you see in most of our businesses. And that thought process is actually the trigger for evaluating what are the options that we have in Amsberg. So these options are being sort of turned out and evaluated, and we'll take a final call. But there are no issues at all in selling concentrate as it is. In fact, some of the concentrate has been advance booked also for sales, which will be our immediate production now when the concentrator gets commissioned in middle of this year.
Thanks. Just one last question. Slide 18 mentions 3 million ton aluminium capacity or production in medium term. This is the first time we are reading this number. So where is this 0.7 million ton expansion envisaged? Is it at Balco or Val?
Basically, this is a little bit of gazing into the future, and we have power capacity with us in Balco and other facilities also. So it's obviously up for evaluation that whether going forward producing more aluminium will be a better option rather than a current selling of the power to the grid.
I understand. Thank you and all the best.
Yeah, thank you.
Thank you. The next question is from the line of Vineet Malu from Birla Sun Life Mutual Fund. Please go ahead. Hello. Hi, good evening.
Vineet, come back into the queue.
Yes, please.
Thank you. So my question is about aluminium. So we have about 1,310 crores of EBITDA this quarter compared to 600 odd crores in Q3. But I'm just not able to understand, where is the major source of incremental EBITDA coming from? What is the major source? Because our volume has gone up by about, let's say 35 KT. Our costs have gone up a little bit, realization has gone up a little bit, but, somehow, we're not able to match the total numbers to the one shown in your aluminum slide.
I think it's a good observation, and as I confirmed earlier, there is this pottery lining which has come up in the aluminum. It's a play between the EBITDA and the depreciation line. So for your modeling purposes, as you rightly observed, this 300-350 crore need to be backed out from an ongoing point of view.
Okay, so it's just 350 crores, is it? Because even then it doesn't explain it completely. That's why I was a little confused.
I think we can work with the IR team offline on this, any specific reconciliations.
Okay, sure. Another question is that, we had guided in last quarter that, our aluminum COP should be around $1,850 to $1,900 odd, whereas it has continued to increase. So just wanted to understand, how are we dealing with the situation and what is happening in alumina market currently, and as well as the external coal.
As I was sort of talking during the slides, the same. So there are a few things which we are doing. Number one, on alumina, what we are doing is current year we produced little over 1 million tons of alumina. Now our capacity is to produce about 1.7 million tons of alumina, and that is what we are aiming to produce this year. So our local production of alumina will increase, and that will reduce that much corresponding imports. That's point number one. Point number two, we will also add local bauxite feed from Odisha to this refinery, which will reduce the other import of bauxite. Plus, it will also give a high quality bauxite to this refinery. So reduce the overall cost of production. So this is on alumina. Some reductions will take place because of these two factors. Then we are also working to take our power plant operations, both in terms of PLF and operating efficiencies, to a peak benchmark levels. And that has a potential to improve our non-coal costs. As far as the coal is concerned, our linkages materializations were lower last year because of transportation and logistics issues with railways, and similarly some GCV issues with what we get and what we pay for. So there is an increased focus on both these elements, and that also gives us a lot of improvement in terms of overall costs. So what I'm trying to say is these are the factors which are very much within our control, and we are working really on this in a very focused way. And the alumina market internationally is quite volatile, as you yourself are aware about. And similarly, the auction prices of coal in India, last year we tried predicting it, but I think we were proven quite wrong. So what we are saying is without those two factors, we have a improvement potential of about $125–150 per ton, and that is what we will get. And anything more happens on this which is favorable to us, so that will also add to our overall cost reduction. So, but at the end of the day, we are actually looking to drive a number of $1,500 per ton as aluminium production cost.
Sure. So last one on this topic only just to close this. So from Coal India, you mentioned that we haven't got complete linkages, and also there were issues about calorific value, etc.
Yeah.
So, so I presume we'll get our linkages fulfilled this year. But about calorific value issue, is there a third-party sampling that you are?
We have a third-party sampling.
Do you get a compensation in case of deficit in the?
There is a possibility of getting compensated if the contracted quality and received quality based on third-party verification is not the same. Yeah.
So you expected to get something for last year?
I'll have to check that in detail and we can come back to you on that.
Sure. Thank you very much.
Yeah.
Thank you. The next question is from the line of Sanjay Jain from Motilal Oswal. Please go ahead.
Hi. This first question is on oil and gas. On the slide 19, you are guiding in the bar chart about the production 220 to 250. So these are like the average production we should expect for the full year, or is it the exit rates we are talking about?
This is an average production for the full year. Sudhir, anything supplement on this?
That's right, Mr. Kora, and we are already at about 203, 204,000 barrels compared to an average of 186,000 barrels last year.
Okay. And the second question is on aluminium business. Actually, there are two parts, one is that regarding the sourcing of alumina, you did mention domestic production will increase. My question is that how are you sourcing the remaining part? Like how much of that is already tied up in contract and how much of that is we are exposed to the spot market? So,
I will ask Samir to supplement, but let me respond to perhaps what you are trying to aim at. Even the long-term contract agreements are also fundamentally off-take agreements, and the price determination is on the current API. And point is, it's not a fixed price off-take contract which have been signed. So, Samir, please supplement.
Yeah, so Mr. Kora, I think as you rightly said, the long-term contract...
sorry, I can't hear you. Can you be either close to the mic or something?
Hello, can you hear me?
Yeah.
Hello. Yeah, so what I was saying that the long-term contracts are 70% as a policy of our total requirement. That's because we always keep 50% spot. But Mr. Kora has rightly said that most of the contracts, we don't actually know more of the contracts we sign on fixed price because we sign on an index, which is either linked to LME or in all majority of the cases linked to API, which is an index which is based on the transactions of the alumina. So while we get the security, the prices are always
I'm sorry to interrupt. I would request you to come more closer to the mic, sir. You're not clearly on.
Hello. Yeah, is it better now?
Yes, sir. Thank you.
Yeah. So I think just to say in a nutshell, we are covered 70% long-term and 30% spot on alumina, which is our strategy, and that is the right strategy. But the pricing of the long-term is on an index base, and index is a market base. So while we get the security of alumina, the prices of alumina are, of course, linked to market, but which we start to see in, let's say, a month or so, because we buy now and we will consume in a month. So that there is a lag on how we see the prices impacting the P&L, but the prices are linked to the market.
Got it. One clarification from the earlier discussion on this aluminium EBITDA. Mr. Arun, you mentioned that in your comments that port line expenses we are capitalizing, which will depreciate over 5 years. And at the same time, you're saying that this is bottom line neutral. Is it bottom line neutral in the quarter, or it's bottom line neutral over 5 years period? This is slightly confusing.
Yeah, very quickly from an accounting basis, historical to date, you tend to do a reserve catch-up, so the difference comes into depreciation. So from an accounting point of view, it's neutral for the year as well as neutral going forward. It's just correcting the presentation till date, that's it.
Okay, but for the quarter it is not neutral, right?
Quarter also is neutral, for the year it's neutral, going forward it's neutral. As I said, it's a pure accounting policy kind of disclosure.
But you're saying it will be depreciated over 5 years, but here you are depreciating in single year. Then if it is depreciated in single year, then only it is neutral. Otherwise,
sure. I think we'll be delighted to engage with you offline and just walk through the accounting treatment.
Okay. Thank you.
Thank you. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. The next question is from the line of Anuj Singla from Bank of America. Please go ahead.
Yes, sir. Thanks for the opportunity. So my first question is on the coal side. Have we seen a material improvement in the coal linkage materialization in this quarter? We had a low of around 37% in last quarter. And have we seen any improvement in this quarter as well as in the month of April?
Samir, would you like to comment, please?
Is indeed better. I think especially ACCL. MCL continues to be a struggle because there was some strike at one of the mines and some issues at Samaleshwari. But overall, still, we are seeing a marked improvement in the Q1 of this year, which is why what Mr. Kaura said about getting a price improvement and a cost improvement in the cost of power. Of course, knowing fully well that the rest of the year can be different, but as of now, we are seeing an improvement here.
And so, sir, when Coal India moves to the GCV-based pricing, which they have already communicated, though yet to be implemented, what kind of impact do we see in our coal procurement cost? Coal India tends to believe it's going to be, positive for their top line. So is that our cost is going to increase? Is that our assessment as well?
Mr. Kaura, I can take that. I think we will see a cost reduction of anything from $10 to $20, depending on, of course, what coal we get. But as compared to an era where we were not able to charge off the cost differences because we were always getting negative GCV deltas, so we are forecasting improvement in our cost of $10 to $15, of course, depending on the actual GCV.
Okay. And secondly, sir, on the second question, this is for Mr. Arun. Sir, on the capex optionality, most of the capex here were very well detailed in the presentation. And just on two parts, the investment plan for Johannesburg, where we are talking about the refinery and the smelter, media reports talk about $800 million of capex. Is that the number we are looking forward to as well, as and when the plan gets decided?
No, I think closer to time, we will come back with the estimates. If you see the experience that we've had in the past, at some point of time, we had significantly high estimates for Ramsburg mine, but we did technology interventions and commercial strategies to bring the capex cost down. So that's like a vision that we do want to invest to get the refinery up at the right point of time. The specific guidance will be given during our quarterly updates.
Yeah. And the decision to go for it or not will also be dictated by the kind of cost and return equation which we see for the particular technologies and smelter installations. Yeah.
Okay. And so lastly, from Electrosteel 1.5 to 2.5, any capex guidance we can, or any benchmark there?
Yeah.
Yeah, I think it should not be more than a couple of $100 million is a broad estimate. But I think the bigger point there is it enables a good integration of the Jharkhand mine leases that we already have, which are at various stages of approval. And it plays into what the country is laid out in terms of ensuring that the iron ore gets end utilized in the country. So I think that's a good integration thing, just as a I'm sure you all have noticed it, one of our credit agencies come out with a positive credit rating report on the completion of Electrosteel process that Moody's came out about 10 days ago, I guess. So that's broadly the update on Electrosteel. Any questions further, happy to take it.
Okay. No, I'm done, sir. Thank you very much, and all the best.
Thank you. The next question is from the line of Ashish Kejriwal from IDFC. Please go ahead.
Yeah, thank you. Sir, my question is again on aluminium only. You mentioned about 350 crore of one-time expenses or maybe over a year. Is it possible to give what it could be on a per ton basis or, continuously going forward, what will be on a quarterly basis?
I think, this is Arun here. I think as we elucidated on the call, subject to the coal and alumina assumptions, we have two big levers in our hand, and in fact three big levers, and I think these are very exciting levers. The last year had significant disruptions and port outages, and you must recollect that we spent about $70-75 on an average during the year per ton of aluminum dealing with those, and those have been handled quite well by our aluminum team and well behind us. That's one big lever. It's what I would say, I think about 85-90% of our pots are what we call category A pots, firing extremely well on all parameters, ramped up well and quite stable. The second lever, as was outlined earlier in the call, is bauxite. And with that, every ton of bauxite you use there, the Orissa bauxite, it should bring the aluminum cost down by about another $125 to $175. Local production. And, the alumina refinery volumes going up to almost 1.5 to 1.7 is our guidance, though we know that we can stretch it to 2 million tons. That's yet another lever. And I keep losing count of levers. The fourth one that the CEO had outlined is also the $125 to $150 lever on various things like GCV, dead wagon realization, other efficiencies that are in our control. Samir even commented about it. And in fact, we could keep adding to the list of the levers.
Plus the improving marketing realizations, our value-added production will increase in tonnage.
Sorry to interrupt, sir. My question was on pot relining expenses, which you are saying it will be depreciated over the next 5 years. So my question was, when you are giving a guidance for FY19 cost of production, are we considering anything of that, sir? Because when we are giving aluminum cost of production separately for this quarter, it is $1970. Obviously, that does not include your pot relining expenses, but we include that in EBITDA.
Considered in our guidance for next year.
So what could be that on a per ton basis? I'm looking at from a quarterly angle, whether, how to look into it going forward.
Sorry, we lost the audio for about 30 seconds.
Okay, I'll repeat it. My question is that the pot relining expenses, you mentioned that it is for a year. Now, going forward, how do we look at aluminum cost of production and thereby the EBITDA numbers of aluminum operation? Do we include this?
Part of the whole cost, some $10, $20, $25 plus or minus. So, perhaps we should have come out with a page on the accounting, but nevertheless, we can handle this offline. Our team will be delighted to interact.
Okay. And secondly, in Talwandi Sabu, though we have achieved this power availability at 93% this quarter, but then also we have given a FY19 guidance of 80%. So, any specific reason for the same, or it will be just...
I think the plant is operating very well, and our availabilities, we are always targeting above 90%. And so hopefully it should, next year also we should see those kind of numbers. Yeah.
So this 80% is, you're saying it's very conservative?
Yeah.
Okay. And lastly, can we have operation bias credit number?
I think the operation bias credit is around $1.4 billion.
Okay. Fair enough, sir. Thanks a lot.
Thank you. The next question is from the line of Dhaval Doshi from Phillip Capital. Please go ahead.
Hello, sir. Congratulations on the good set of numbers. Sir, just on slide 31, the EBITDA bridge, the others column of 258 crores, that includes various aspects, which is one of... Hello?
Sorry, we don't have an audio.
Sir, can you hear me?
Hello?
Yeah, can you hear me? Hello? 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 Hello?
Yeah, we are able to hear you again.
Yeah. So my question is on the EBITDA bridge slide, slide number 31. The other section, which is 258 crores, can you give me a rough breakup for that? Because it includes some impact of the PPA business and power.
Hello again. We have the audio faded.
Hello. That was just 1 minute. Participants, you are requested to stay connected while we reconnect the management. We have the line for the management reconnected. Dhaval, please repeat your question.
Yeah. So my question was on the EBITDA bridge on slide number 31. The other segment of 258 crores, can I get a breakup of that? So there's some one-off impact in the power segment in that as well, and the other cost. And the second will be, sir, the 350 crores benefit in the aluminum business. Which line item on that EBITDA bridge would it get reflected?
That would be under others, but the rest of the breakup, I don't have it offline. We have a small comment below the bar chart, if I recollect, but we can send it to you offline.
Okay. Fine. So second question would be with regards to the bauxite sourcing. Can we have a rough split of the various sources of bauxite that we're going to be having for FY19?
See, our refinery capacity, as we were saying, will be about 1.5 to 1.7 million tons here. So fundamentally, we need approximately 5 million tons of bauxite, right? Correct. So we have three sources locally. Our own mines in Chhattisgarh, Balco mines, and then this OMC mines in Orissa, and third is some other supplement from domestic whenever required. And then balance of this will be also imported bauxite. Because, and as I was saying, this Orissa mines start ramping up, our supply volume will keep on coming up. And then some adjustment to the volumes of other sources will get made, because this is the best and the cheapest bauxite source.
Sir, can I have some numbers to this? So you said 5 million tons. So how much would come from captive, how much from OMC?
Yeah. So maybe immediately I may not be able to tell you this, but we can certainly advise you that,
Okay. Fine. Thanks a lot, sir.
Yeah.
Thank you. The next question is from the line of Pinakin Parekh from JP Morgan. Please go ahead.
Yeah, thank you very much. Three quick questions. My first question is, if I look at the standalone balance sheet, there has been a material increase in net debt. Now, what I understand that there was a large dividend which was paid out by Vedanta. There was a dividend.
You're fading again. The voice. Sorry, operator.
Pinakin, just hold on. I'll check with the management.
Yeah, we can hear you, operator, now. So let Pinakin continue with the question.
Okay. Pinakin, please repeat your question.
Yes. So basically on the net debt on the standalone entity, there has been a material increase on a quarter-on-quarter basis. Now, there was a large dividend paid out by the standalone entity, which was not considered before Hindustan Zinc paid. There is a very large capex pipeline, as slide number 18 suggests. There would be debt increase because of the electro-steel acquisition, and we're not even counting the SR bid in place. So just trying to understand the balance sheet outlook going forward, especially as a Vedanta standalone entity. Should we expect leverage to increase from here? I mean, if dividend payouts remain at this, or will leverage on an absolute basis, net debt, come off from here over the next 2 years?
So it's a very good question, Pinakin, and we don't guide the specific debt numbers, as you're aware, or the cash flow numbers, or for that matter, the EBITDA. But if you look at the bigger picture here, the aluminum business is now matured into a 2 million ton business. And, based on all the underlying improvements that are completely in our control, bereft of the commodity market scenario, I think it's fair to assume a good $400, $500 margin from that business. Cane oil and gas continues to do very well, and if you see as I outlined, 220 to 250 range, you could well be 20 to 35% growth in volume. And if you put this together, there is significant cash generation in the standalone balance sheet. Needless to say that Hindustan Zinc continues to be exceptionally strong, as you also heard their management day before. And I think with these three sources of cash, one should look for a good trajectory, which very clearly underlines the fact that all our capex will be self-funded, as I mentioned earlier. And with the net debt to EBITDA ratio of 0.9 for the Vedanta consolidated, I think that leaves behind a significant headroom to earn and spend wisely on growth capex as well as return shareholders and delever the gross debt. So I think we have multiple sources of cash, and the business is in good shape to handle whatever capex requirements that we have.
Sure. My second question is related to the news report in ET, which obviously Hindustan Zinc did not comment much on, but just trying to get a sense that over the last few years, the Vedanta Group has strived to reduce the number of listed entities that were there, and now it's down to 3 entities. But going forward, are there thoughts to change the group structure and have introduced other listed entities, either below Vedanta Limited or above Vedanta Limited? I mean, just trying to understand, because that news flow was, it came something out of the blue for many investors.
Yeah, fundamentally, we not understand the basis for your question, because there is no plans and to structure on that basis. So I don't know. Whether, there is any... You want to supplement...
I think there is no fundamental change in thought process, but we have to understand that Hindustan Zinc is a very, very high-quality asset. This is one of the few companies which has really 2 big EBITDA streams. One is zinc, which is one of the best mines in the world and a single decile on the cost curve, and the other stream being silver. So I think these news reports are speculating about why don't we split the streams of cash flow so that the earnings, or rather the valuation is enhanced, because today a combined company perhaps gets a single valuation. So these are all thoughts in the public domain and probably the local board there. And we'll see how the future pans out. But otherwise, the group is pretty much... thinks it's a highly valuable asset, whichever cash stream you take.
Sure. Thank you. And again, apologies on a last question in aluminum, but we used to get a segment slide which used to have the cost breakup. Now, 1970 was the cost as of 4Q average. 1725 to 1775 is the guidance, assuming input costs revert back to FY18. What would be the exit cost or cost based on April input cost? I'm trying to understand what kind of mean reversion we need to see in input cost for us to go back to 1770, because I would assume current COP should be materially higher than the 1970 that was reported in 4Q.
So I think what we are refraining to comment is on the way the volatility in the alumina market is there today, and how the prices are moving. So our guidance of 1770 was fundamentally to say that we have a potential to improve this cost by this margin of $150 or so. But this volatility in the market can improve or upset these numbers. So that is the point which was being made.
Sure, sir. So just the $1970 of 4Q is based on what imported alumina cost? Is it around $400?
Yeah, so we can give you that number, I think.
I think, Samir, you can add here, but it's probably at about 23 to 25% alumina percentage aluminum, Samir.
Oh, I can tell you that.
Samir, are you still there on the call?
786.
Hello, yeah, there, but I could not get the question. The question was how much is the alumina cost and the overall cost of alumina, is it?
Yeah, what is the
alumina price?
Alumina component in that?
About 21%. Alumina cost is 21% of LME.
Yeah.
Understood. Thank you very much, sir.
So I think as Mr. Kora has said rightly, it's so volatile and you must have seen the prices have moved up in one day in alumina almost by $150. So I think we have to be quite cognizant of that so let the situation stabilize and...
Understood. Thank you very much, sir.
Okay.
Due to time constraints, that was the last question. I now hand the conference over to Mrs. Rashmi Mohanty for closing comments.
Thank you everyone for joining us today for our Q4 and FY18 full year results discussion and presentation. If there are any further questions that you may have on the results, you can always reach out to the Investor Relations team. Thank you.